Hello friends, welcome to the channel of Rakesh Nanda. This channel is on important aspects in understanding trade finance. We are running an educative series on different topics on banking. In order to remain informed about our subsequent episodes on various topics, please do not forget to press subscribe button and also press bell icon. We assure you that we'll make valuable contents for you to improve your skills on all aspects of banking. So, your small gesture for pressing the subscribe button will motivate us to make more and more interesting videos for you. Let's go ahead. So, welcome back, friends. Uh, this is episode 2 in our trade finance series. The first series was to understand what are the commercial documents as well as what are the payment modes. This episode, we are going to focus on transport documents as well as insurance documents, which are important part of any trade transaction. The other documents which could be there in trade transaction could be transport documents and insurance documents. Let's try to understand these documents. So transport documents can be multiple depending upon the mode of transport. So if the goods are sent by ship, then it's bill of lading. If the goods are sent by air, then it's a airway bill. If goods are sent by railways and railway receipt, by lorry, it's motor transport. If postal receipt or courier receipt. Why this transport document is important? Because this transport document actually proves the title to goods. The ownership of goods lies with the person in whose favor this transport document is made. So if you recollect, in bill of exchange we said that it's a negotiable instrument. What is the definition of a negotiable instrument? It is transferable by endorsement and delivery and is also tradable in the market. While transport documents, which means that all negotiable instruments are transferable and tradable. So transport document has a different property, even though it is transferable by endorsement and delivery, but it is not negotiable. So if you recollect your school days, we used to say that all negotiable instruments are transferable, but all transferable instruments may not be negotiable. So transport document falls in the second category. It's even though it's a transferable document, but it cannot be traded in the market. Now this transferability brings a unique flavor for this document because when the goods need to be sent to a destination in a particular city, then those goods will be lying with the transporter, but the transporter will not give delivery of goods to any person who is not authorized through that transport document to take delivery of. And since the transport document is routed through the banking channels, so bank will not make it transferable in favor of the buyer unless buyer fulfills the conditions as given by the seller. So that brings the good combination with other documents in a trade transaction for transport document. So first important transport document is bill of lading. Almost 80 to 90% trade, global trade happens through cargoes and through ship route only. So bill of lading is a transport document which is issued in case the goods are sent by ship. So bill of lading is a transport document representing movement of goods by water or ocean. It is a formal receipt given by the ship owners or their authorized agents stating that the goods mentioned therein are shipped through a specific vessel on a specified date. So the vessel also need to be specified, which means the name of the ship, and these goods are deliverable to the person mentioned therein, which means the name of the person should be mentioned on the bill of lading or to his order, which means it can even be made transferable to another person. So in whose favor it has been transferred, that becomes the owner after payment of all dues of the shipping company. So these goods will be delivered by the shipping company provided the person produces the document, shipping document, which is in his favor, and after ensuring that the shipping company has been paid their dues. This is the specimen of bill of lading. If you see various columns in this, so it contains information like who is shipping the documents, which means the seller, generally the seller, but it could be a third person also, and to whom these goods are being shipped, any third party intervention, any special instructions if you want to give, then bill of lading number, carrier's name, then freight charges terms, which means how the freight charges are going to be paid or who is going to pay it. Then order number, number of pieces, weight, and uh, weight and um, uh, other terms and conditions in the shipping, including all those terms which are important from the point of view of intervening costs, which are known as Incoterms, for which we'll take the session separately subsequently. And this is all the terms and conditions of shipping are also contained in this shipping document, and these are duly signed by the shipping company, and the designated authority of the shipping company must be mentioned on this document. Then the bill of lading actually proves a document of title to goods. It's a document which proves title to goods. So relevant transport document under shipment is bill of lading, and the shipping company delivers the goods to the consignee only upon production of original bill of lading. Generally, bills of lading are issued in a set of 2, 3, 4 as per the requirement of the buyer, and exact number of originals issued is indicated on the bill of lading. So it is written on the bill of lading, says 7 bill of ladings have been issued. It means 7 originals have been issued. Production of one original negotiable bill of lading is a must for claiming the goods. Bill of lading is thus termed as a document of title to goods, as I have already shared. In whose favor this document has been made, he becomes the owner of the goods. Then, as I narrated in the previous slide, that bill of lading has a quasi-negotiable properties, which means that it is not fully negotiable. So a bill of lading possesses some of the qualities of negotiable instruments, which means it can be made transferable by endorsement and delivery, but it is not tradable. So it actually represents title to goods, and different from bill of exchange in the sense that bill of exchange can be traded, this cannot be traded. So in a trade transaction, generally when bill of exchange is coupled with the transport document, then bill of exchange narrates the conditions of payment, while bill of lading proves the ownership of title of goods. Then any bill of lading, if it is issued by a company where they have used the word received, it means these goods have been received for shipment, but actually the goods have not been shipped. Let's understand it by way of an example. Suppose there is an exporter in Delhi. Delhi doesn't have a port, but Delhi will have a lot of shipping companies' offices. So, in order to give better customer service at the doorsteps of the exporter, so exporter can actually ship the goods through their shipping company's office in Delhi. But when these goods are received by the shipping company in Delhi, they will issue a bill of lading which will be received for shipment. But actually, shipment will not take place today. Probably these goods first will go to Mumbai, which is the nearest port. Then the ship may take another 15 days to arrive. Then loading might happen in another 10 days. When the loading will happen, only then it will be treated as shipped. So there is an onboarding narration which has to be given on the bill of lading, and all bill of lading as a transport document has the most important date as onboarding date, which means the date of shipment, because most of the trade transactions, the usance period or delivery time, etc., is counted from the date of shipment, and date of shipment is proved from onboarding stamp. So in an example which I have given you, when the goods will actually be loaded on the ship, at that point of time they will be treated as on board. So the exporter need to bring this bill of lading to the shipping company's office in Delhi, and they will put a stamp on that onboarding date is so and so. So from that date their shipment date will start. Then what is a short form bill of lading? See, a bill of lading, as you know, is a contract for carrying goods, and it should contain all the terms and conditions of the contract, which means the contract between the shipping company and the exporter to carry goods. All those terms and conditions of shipping should be there on the contract. Sometimes a bill of lading is issued where it is written something like that, terms and conditions of the shipment will be as per the contract dated so and so. Then that is a short form or blank back. It means all the terms and conditions are not written on that bill of lading. So the global language used for such a bill of lading is known as short form or blank back. And sometimes in the letter of credit issued by a buyer, they sometimes stipulate that bill of lading should not be short form or blank back, which means all the terms and conditions should be mentioned on the bill of lading. So in the LC, if it is written that short form or blank back is acceptable, only then we'll accept. What is a clean bill of lading versus closed bill of lading? See, on any bill of lading, if any of the conditions or if any of the narratives indicate the chances of deterioration of goods in transit, then it is known as a closed bill of lading or foul or unclean bill of lading, which means the bill of lading should be clean. Means uh, clean means that there should not be any condition which can indicate any defect in the condition of the goods. So such a bill of lading will be known as clean bill of lading. So sometimes in letter of credit, it is mentioned that closed bill of lading is not acceptable. I give you an example. Suppose if a shipping company uh, mentions on the bill of lading that 10 cartons are being dispatched, out of which 2 cartons were open. Now it's a closed bill of lading because you cannot call it a clean bill of lading, because shipping company has already indicated in their bill of lading that there is a chance of two cartons being open, the goods can get destroyed. So it will not be treated as a clean bill of lading. And what is a straight bill of lading? A bill of lading which is issued directly in the name of the buyer is called a straight bill of lading. Normally, when the documents are being routed through the banking channels, the bill of lading is, being a transport document, is issued in favor of the bank, and bank endorses it in the favor of the buyer as and when the condition of sale are fulfilled by the buyer. But if the bill of lading has been issued directly in favor of buyer, it is known as a straight bill of lading. And banks find such a bill of lading as risky if the documents are being routed through the banking channel, because if this bill of lading is lost in transit, then there is a chance that buyer may take delivery of goods without making payment. So to cover this risk, uh, bill of lading should be, and bill of lading being a transferable instrument, one must take a precaution that it is not issued in favor of buyer. What is a charter bill of lading? Now, sometimes what happens is that there are liner services in cargo shipping companies. What is these liner services is that suppose a ship is carrying goods from India to Singapore. So this ship will deliver the goods and will is likely to come back vacant. Similarly, there will be a company in Singapore, shipping company, which will send their goods through their ship to India, and their ship will be going back vacant. So a lot of shipping companies, they hire space on each other's ship so that their ship doesn't have to go back vacant. So they sublet their space to various charter parties. So there is a separate charter party agreement done with the shipping by the shipping company with the charter who has hired the space, and that charter offers this space in the ship to various exporters for sending their goods. Now, there is an inherent risk in this for the exporter in sending goods through charter party, because if tomorrow there is a dispute in payment of shipping company charges, so shipping company has a right to take possession of these goods and dispose it off in the market to recover their shipping charges. But the goods actually are belonging to the exporter, not to the charter party. So, since banks grant facilities to the exporter against these goods as securities, so this risk passes on to the banks also. So, banks generally are very careful while accepting charter party transactions, and they would like to see all the terms and conditions of the charter party, and unless it is permitted in the LC, letter of credit, the charter party bill of lading may be accepted. They generally avoid accepting charter party bill of lading. So this is the associated risk in case of charter party, which I just explained, that if there is a dispute between the shipping company and the charter, then the shipping company can take custody of goods. So the owner of the vessel often have the right to lay claim to the cargo aboard the ship. For this reason, banks generally refuse to accept such bill of lading as collateral for loans or for payment under a LC. So let's try to understand what is an airway bill. As I told you, almost 80 to 90% cargo is transported through the ship routes. But during the last 10-15 years, there are a lot of big aircrafts. So airlines also have started shifting cargoes from one place to another place. But historically, airlines have never been accepted as a normal cargo service. So that's why airway bill has never had acceptance under the quasi negotiability clause. So Airway bill actually is an acknowledgement of receipt of goods. So the moment goods are taken to the airline's office, airlines will issue an acknowledgement and the goods will be treated as having been shipped. It might be that the aircraft is being loaded after 1 day or 2 days for sending the goods, but it will be treated as the moment these are received by the airlines, it will be treated as having been shipped. The second drawback in airway bill is since it's an acknowledgement of receipt, so it is not transferable by endorsement and delivery, which means when the delivery needs to be taken for the goods, for the arrived goods, then either the person in whose favor this airway bill has been issued, he has to go and take delivery of goods, or he has to give a letter of authority to the person who will represent him in taking delivery. So there is an operational inconvenience also in ensuring proper title of goods. So these are the two drawbacks in airway bill. Otherwise, airway bill also these days is uh, quite an acceptable instrument in trade transactions. Then there is a forwarder's cargo receipt and what are the associated risks with that. What is a freight forwarder cargo receipt? Lot of freight forwarders these days. Who is a freight forwarder? These are the logistic companies who actually arrange for your uh, cargo packing and loading, unloading, custom duty clearance, etc. So they have started adding more uh, value to their business relationship by hiring spaces in the ship. So freight forwarders, what they do is they hire a space in a ship, and they are permitted to issue a freight forwarder's cargo receipt in favor of the exporter who takes space through the freight forwarder cargo agent. So freight forwarder cargo agent actually acts as a intervening party. So the contract will be contract of shipping will be between the shipping company and the freight forwarder cargo agent, while the goods will be belonging to an exporter. So the risk element is the same as we saw it in a charter party. That tomorrow, if there is a dispute between the shipping company and the freight forwarder agent, then the shipping company can take possession of goods for disposal and recovery of shipping charges, while the loss will be of the exporter. So that's why banks avoid freight forwarder cargo receipt unless it is permitted as per the terms of the LC. Then same thing is possible in case of house airway bill. What is a house airway bill? In airlines also, they are allowed to offer space to air consolidating to various cargo consolidating agents. So these agents, which are basically logistic companies, they uh, hire space with the airlines and offer it to various exporters for sending their goods uh, through these agents. And these agents get a master airway bill from the airlines for the airlines having sublet this space to the cargo agent, and cargo agent in turn is allowed to issue a house airway bill to the exporter whenever exporter hires space in these airlines. So again, house airway bill has the same risk as we saw it in a freight forwarder cargo receipt, because here if there is a dispute between the airlines and the cargo consolidating agent, airlines can take possession of goods, so the loss will be of the exporter. So banks don't accept house airway bill unless it is specifically permitted to be accepted in LC. Then multi-modal transport documents. These days, lot of shipping companies they offer end-to-end services. What are end-to-end services? They say suppose there's an exporter from Delhi who is exporting goods to New Jersey in US. So the shipping company offers him facility that will book your cargo door to door, that will take this will pick up your cargo from your factory and deliver it to the factory of the buyer in New Jersey. Now, naturally, there are various transport modes of transport which will be used. For example, from Delhi to Mumbai, suppose these goods are going by rail. Then from Mumbai to New York, they are going by ship. Then from New York to New Jersey, they are going by truck. So shipping companies, they offer the facility of a multimodal transport document, which means they will issue a single document which will cover all modes of transport. So this single transport document, which will cover all types of transport, is known as a multimodal transport document. It has the same properties as a normal bill of lading. Then insurance documents. The most important aspect of insurance, whenever we are sending goods, it is always advisable to get it insured for any to cover any risk of loss, theft, etc. But it has to be seen that cover note is not a policy. So one should never accept a cover note. Cover note is only an acknowledgement of receipt of application for insurance. So the actual policy, unless it is issued and signed by the underwriter, it cannot be accepted as a um, document for a complete document for insurance being complete. So one should always insist for a insurance policy rather than the cover note. There are two policies. One is a specific policy and second is the open policy. Specific policy is the one which is taken uh, for a specific voyage and for specific goods. And open policy is that suppose there is an exporter who knows that he's going to have a target exports of 10 crores this year. So he takes an open policy of 10 crores. Within these 10 crores, he's sending various consignments. Maybe today he has sent it for 15 lakhs to Poland. Tomorrow he has sent 5 crores to US. Like this, every day he's sending some consignment. So on each day, whenever he sends a consignment, he just needs to send a letter to the insurance company that under this open policy, I have dispatched this much of material to such and such client in such and such country. So this may be treated as insured under the same open policy. So unless he completes that 10 crores, he has the flexibility of using it for various buyers in various countries. He just need to ensure that he is informing insurance company at the time of dispatch of those specific goods. The advantage to the exporter is that it is operationally convenient to handle open policy, plus the premium is also comparatively lower than the specific policy. Otherwise, for every consignment, he every day basis, he has to go to the insurance company and get insurance done. That is all in this chat in this episode, friends. We hope we have been able to add value to your knowledge. Our next episode is going to be focused on documentary collections. Please, if you have not subscribed it so far, please push please press the subscribe button in order to remain well informed when the next episode is launched, which will be done within this week. So please keep watching. Thank you and have a good day.